Welcome back, folks. Episode 4 of the True Money Podcast. This is a direct continuation from episode 3, where we examined comments from Hayek around elasticity, a required elasticity of the money supply, which of course would rule out Bitcoin. We'll continue on in this episode 4 looking at some comments from Mises and Menger. If you remember the Bitcoin Standard book by Saifedean Ammous, Saifedean asserted that Bitcoin satisfies Menger, Mises and Hayek. Bitcoin satisfies the Austrian School of economics as to its claim to be sound money. Now we've seen in episode 3 that it didn't satisfy Hayek. In this one we will look at Mises first. We have Mises on screen. Let's go ahead and read through it and call out the parts that we want to have a much closer look at. So Saifedean begins here by stating that the Austrian School argues that the quantity of money itself is irrelevant, that any supply of money is sufficient to run an economy of any size because the currency units are infinitely divisible and because it is only the purchasing power of money in terms of real goods and services that matters and not its numerical quantity. So that's quite a long sentence. It's quite a mouthful. We're going to have to go back through that and just pick the sentence apart so that we understand exactly what Saifedean is alluding to here. So first of all, the Austrian School argues that the quantity of money itself is irrelevant. Now, that is correct in a very narrow sense, and we'll look at that as we go through this statement from Mises, the part I've highlighted in the reddish colour here in particular. So he said the quantity of money itself is irrelevant. Well, we know that changes in the quantity of money play a major factor, and we know this from hyperinflation periods where the quantity of money is just blown out by massive money printing, and that clearly leads to purchasing power declines and price inflation. So to say that the quantity of money itself is irrelevant, that's only applicable to a very narrow case. We'll look at that in a second, but let's go back through, let's continue on with this sentence and so that we can analyse what it means. That any supply of money is sufficient to run an economy of any size. Now, that's another interesting comment, because there doesn't appear to be much evidence for that. It is a bit of a bizarre statement. If you think that, let's say you have 100 currency units to run a major national economy, that is obviously far too tight of a money supply. So I don't know where he thinks he has some evidence to state that any supply of money is sufficient to run an economy of any size. That's clearly not correct. But let's read on. Because the currency units are infinitely divisible is inserted into this sentence, and that statement is very strange. Firstly, because there is absolutely no reference to it at all in any Austrian writing, and if you remember, the whole subject of this sentence is Saifedean is claiming that the Austrian School, this is what they are arguing. So Saifedean saying that the Austrian School has stated somewhere that any supply of money is sufficient because the currency units are infinitely divisible, which is odd and incorrect. And of course, we can see where he's coming from with this statement for anyone that is, been aware of debates around Bitcoin, because this is an argument that Bitcoiners often make, this argument that Bitcoin is infinitely divisible. And there are some issues with that argument, but firstly, Bitcoin is not infinitely divisible under its current schema. There are 100 million Satoshis, so each Bitcoin can be broken into 100 million Satoshis. Now that is obviously very, very small, so it's divisible into very small amounts, but it's not infinitely divisible unless the code was changed to add on more and more zeros. So under its current schema, under its current protocol, Bitcoin is not infinitely divisible, but I have had some arguments, many arguments on this point with Bitcoiners before, where they simultaneously argue that it's absolutely scarce, plus also infinite, because it can be infinitely divided. Now, which one is it? Is it scarce or is it plentiful? And the problem with the infinitely divisible argument, even if you were to add on zeros after zeros after zeros and keep breaking the same money unit, i.e. 1 Bitcoin, keep breaking it up into smaller and smaller pieces, that does not impact the purchasing power increases that we see at the unit level and subunit level, i.e. the overall supply does not change just because you can break a unit up into smaller pieces. And it is that overall fixed limit of overall supply wherein the problems lie with Bitcoin, as we've seen with the Hayek's comments from the previous podcast, that the money supply must be elastic. Now, you can't provide that elasticity just by breaking units into smaller and smaller pieces, because it's the purchasing power that is problematic. Let's read on. Because it is only the purchasing power of money in terms of real goods and services that matters. And this is the key thrust, and this is one part of this whole sentence that Saifedean has actually got correct. The rest of it's kind of nonsensical. But let's read on. Let's see the sentence that has been put together in respect of the actual Ludwig von Mises comments. So Mises wrote, "The services money renders are conditioned by the height of its purchasing power." Again, that is critical. Nobody wants to have in his cash holding a definitive number of pieces of money or a definitive weight of money. He wants to keep a cash holding of a definite amount of purchasing power, as the operation of the market tends to determine the final state of money's purchasing power. Okay, so it's quite a mouthful, but what this actually means, this does not mean, going back to Saifedean's analysis of it and Saifedean's conclusion up above, which is the quantity of money itself is irrelevant. Well, it is only in a very narrow meaning, and what this statement from Mises means, that, and the best way to think of this is, obviously he stated very clearly that it's the purchasing power that matters, and what this means then, that the purchasing power matters but the quantity doesn't. For example, if you always like to have enough money in your pocket so that you can buy a regular hamburger at any time, any place. If you're in the UK, you might have £6 British pounds in your pocket so that you can buy that hamburger. That £6 will buy you a hamburger. But if you go to Poland, you will need 30 Polish zlotys in your pocket to buy that hamburger. And that is all that Mises means with his commentary here around the definitive number of pieces or definitive weight. He just means that there is no mathematical formula that a person can look at an overall economy and say, oh well, you need X number of money units for this economy. That's not how the quantity of money works. The relevance of the quantity of money is, and indeed changes in the quantity of money, are only relevant and are to be measured at the purchasing power level. So hopefully that makes sense now as to what Mises actually meant. And again, with that in mind, we can go back now and look at Saifedean's conclusion again. So Saifedean is saying the Austrian School argues that the quantity of money itself is irrelevant, but not if the money's fixed limit. If you have a fixed limit money, that's a completely separate problem. Saifedean seems to be taking this comment from Mises completely out of context and arguing that it's totally fine to have a fixed limit of money, which is certainly not the case. That any supply of money, again just reading from Saifedean's conclusion, any supply of money is sufficient to run an economy of any size. Well, that's just nonsense. that is obvious nonsense, and I am happy to debate Saifedean on this at any time. And as we go through this podcast, we'll see a number of such examples that I'm quite surprised that nobody from the Mises Institute or no prominent Austrian economics professor has actually called Saifedean out on some of these conclusions, but they're completely incorrect. Because the currency units are infinitely divisible, so we covered that already, and that there's absolutely no reference to this at all in any Austrian writing. Of course, they would have had to predict the invention of computers and the invention of digital money, because you cannot have a physical commodity money that's infinitely divisible. There's only so much smaller that you can break a physical piece of metal, for example. So this statement, because the currency units are infinitely divisible, it appears to me that an editor of the book or somebody in Saifedean's research team has decided to stick this part into the sentence because of the Bitcoin argument that Bitcoin is infinitely divisible, which we've already covered is incorrect. It is not infinitely divisible under its current coding. The code would need to be changed. And again, he ends his sentence hinting on one of the only truths in the whole sentence. It is only the purchasing power of the money that matters. So there's no whenever we conclude this part around Mises and what Mises meant by the quantity of money is irrelevant, only that very narrow term, and that money cannot be calculated as to how much money is needed to service an economy. That is based on the purchasing power, and we know from Mises' regression theorem that the purchasing power of money today is a function of its purchasing power yesterday and the day before that, etc. Let's move on and look at the statement down below from Rothbard, where Saifedean states that Rothbard concurs with Mises on this point that the quantity of money is irrelevant, i.e. a money of a fixed limit is totally fine, which it isn't. Rothbard states a world of constant money supply would be one similar to that of much of the 18th and 19th centuries, marked by the flowering of the Industrial Revolution. So this period of history of rapid development in machinery that led to the Industrial Revolution that began essentially in the UK coincided with a gold standard in the UK. So these two developments happened somewhat simultaneously, and what Rothbard refers to here as a constant money supply, I think it's unfortunate wording from Rothbard. I don't think he means constant in respect of a very rigid issuance, because he is referring to the gold standard, and one has to remember that these Austrian economists, when they were writing about the gold standard, they're often simply making a comparison between gold as money and fiat currency, which of course they were very much against. So when Rothbard writes about a constant money supply in the 18th and 19th centuries, he means a gold standard as opposed to a fiat money supply, which is at the whims of central planning and at the whims of bank credit. So this constant money supply that he means, of course, the gold supply would have been in and around 1.5% to 2%, but with some natural elasticity over this period of 100 to 150, 200 years. So he goes on to say, increased capital investment, increasing the supply of goods, and with falling prices for those goods, as well as falling costs of production. So those falling prices, falling costs of production were factors. They were outcomes from productivity gains, from the new machinery, the new inventions, coal and steam powered machinery, which, as you would expect, if significant advancements are made in productivity, then the cost of production and goods would fall. That is not a direct although the money supply certainly plays a stabilising factor in that, but it's not a direct result of having this gold standard money supply. Whereas you can see from Ammos's conclusion below, he seems to indicate that it is. So Ammous writes, according to the Austrian view, if the money supply is fixed, then economic growth will cause prices of real goods and services to drop, allowing people to purchase increasing quantities of goods and services with their money in the future. So I would disagree with this conclusion. The Austrian view does not agree with a fixed supply of money. Saifedean is grasping at straws to come up with scholarly evidence to support Bitcoin and its fixed, rigid schedule of issuance and absolute fixed limit at one point in the future. And pointing to comments around the gold standard does not provide the evidence that Saifedean claims it does, and we will look in a later podcast, look closely at the differences between how gold as money operated and how Bitcoin might operate if it was indeed money.